Hello there, folks. My name is Spencer Anglin. I'm with Velocity Financial. I'm a certified mortgage planning specialist, and I want to quickly cover the top 5 negative equity solutions and how to correctly use them. There's good news out there in the mortgage world. The average 30-year fixed mortgage rate is as low as it's ever been in the last 50 years since they started recording mortgage rates. The bad news is that with an unstable economy, home values have been declining, and negative equity for a lot of people out there. They can't take advantage of these mortgage rates because they can't qualify for the mortgage. It's very tough to qualify for a mortgage nowadays with an unstable economy and a job loss here or there or a cut in pay. You know, debt-to-income ratios may not work out for somebody. And for a lot of people that are upside down, they can't take advantage of the market either because you have to have equity in most cases. There are some strategies out there that could help you, and I want to quickly discuss these strategies in this video and then have you give me a call back if you have any questions. Why am I doing this? Because I'm passionate about you. You're either a past client who's already done business with me, a real estate agent who's referred business to me. You could be one of the CPAs, financial planners that have referred business to me, or one of the clients that was referred to me by one of those people. And I want to make sure I share this information with you, or that you can share this information with somebody else who may not have been able to take advantage of the low mortgage rates yet. I'm CMPS certified. I'm a certified mortgage planning specialist. Less than 2% of all originators in the country have this designation. It's not an easy one to get. I'm very proud of it. I wear it like a badge of honor. It means that I'm well educated in the rules of taxation as they apply to mortgages. I'm also familiar with cash flow and tax planning. I'm also familiar with real estate investing planning. So, if you have any questions regarding those items, feel free to give me a call. But my promise to you is that you will walk away with specific ideas and strategies, resources that will help you make the best decision and take the best course of action to minimize interest and taxes and maximize your cash flow, essentially. Why do I do all this? Because I work solely by referral. The first program is called HARP 2.0. It was recently introduced back in March, and it basically allows anybody with a Fannie Mae, Freddie Mac loan that has no late payments in 6 months or no more than one late pay in the last 12 months with a loan that was originated and secured prior to June 1st, 2009 to be able to refinance even if they're upside down. If there was mortgage insurance, it should be transferred over to the new lender, and in most cases an appraisal is not needed. The people who benefit is anyone who has a Freddie Mac or Fannie Mae loan who wants to lower their payment, essentially, and wasn't able to take advantage of the lower rates because they didn't have equity. Lowering payments is good no matter what. It helps families stay in their homes. It funnels money into the economy and back into their pockets or their savings accounts. And fewer foreclosures is always good for the homeowner, a neighborhood, and the housing market. So again, if you're in that situation, please give me a call and let's see if we can come up with a course of action that works good for you. Then there's the government-insured Streamline refinance. If the loan is owned by FHA, VA, or USDA, it doesn't matter if the home's underwater. As long as you make your payments on time, you can refinance from FHA to FHA, VA to VA, or USDA to USDA. And the only real fees that there will be are some closing costs that can usually be paid for with your rate lock. And then also there's new funding fees involved with FHA and VA, and sometimes with USDA. The good news is a lot of people that weren't able to take advantage of refinancing their FHA loan because of the increases in mortgage insurance that we've seen in the past 2 years, well, they'll be able to take advantage of those lower rates after June, okay? Basically, if you have the mortgage insurance drops from 125 basis points, which basically is adding a point and a quarter to whatever rate that you get from FHA. So your savings, you basically would have to have your rate go down more than 2 points in order to make it worth your while to refinance at that rate. Now it's going back to the old mortgage insurance that a lot of people have prior to October of 2010 of 55 basis points. And again, that's for FHA case numbers assigned after June 11th and for loans that were originated prior to May 31st, 2009. I can only imagine that that rule is there because they don't want to issue any refunds of the upfront mortgage insurance to help pay closing costs. Who benefits from this? Anyone with a government-insured loan, obviously, who wants to lower their payment. And for the same reasons. Lowering payments helps families stay in their home, funnels money into the general economy. And fewer foreclosures is good for everyone, the homeowner, the neighborhood, and the housing market. So again, if you have a government-insured loan that's over 5%, give me a call. Let's see if this is something you can take advantage of. Then there's the cash-in mortgage. Now, for people who actually have cash in the bank, who would like to have the option of being able to not have to short sell their house to move or to be able to get a higher rate of return on their money, well, maybe they should look at doing a cash-in mortgage. Chances are the money that they save on the cash-in mortgage might have a higher rate of return than the interest that they're earning on the money that they would have to bring to the table to put them into an equity position. As you can see in this example, I've got a $180,000 mortgage, and if you bring $60,000 cash in to put that home into an equity position, essentially, that $180,000 mortgage at 6.5 now becomes a $120,000 mortgage at 4.5, saving $525 a month. And the rates are actually better than 4.5, but I wanted to use a conservative example. As you can see, with the monthly savings multiplied by 12 and then figured into an annual savings calculated with the investment, you've got a 10.5% cash-on-cash return on investment. And that does not include the cash flow of $525 a month going back into an interest-bearing account, probably earning interest compounded quarterly or monthly. So you also have some additional interest to be earned on that money that you're saving as well. So it's a very great option for anyone that happens to have the cash in the bank, and it's not going to wipe them out, but they've got the cash in the bank. They just haven't been able to refinance because they were upside down on their mortgage. This might be a very good idea for them. It reduces stress for obvious reasons. Saving money always reduces stress. But really what it does is it opens up options. It means that now you've got more money to spend on other things that might maybe for home improvement or, to help you out with other places where you've got indebtedness. Or it puts you in a position to be able to sell your house at a later date without having to do a short sale and ask the lender to forgive a balance for you or something like that. So as long as you know you're going to be in the house for a little while, to see that savings for a while and get that return on your investment, it totally makes sense for you to do this because it saves money. Obviously, what you should do next is give me a call and let's see if that works for you. Then there's the option of short sale. If none of the other options seem to work, you might just need to get out from underneath that debt, especially if it's too much for you to take on. That payment is too high. In this example, if somebody bought a house for $350 and they had a mortgage balance of $300, well, their home's only worth $250 now, so there's a $50,000 difference. What you're doing is you're asking the lender to forgive that $50,000 difference. Knowing the difference between a recourse and non-recourse state is important because if you're in a non-recourse state like Arizona is, you don't have to worry about whether or not that they can come after you for that deficient balance. As long as that money was used to purchase the home and it was acquisition indebtedness, then you're going to be able to not have to worry about whether or not they're going to come after you and collect if this is your primary residence. Things to prove when you're trying to do a short sale, you basically got to type up a borrower hardship letter that explains what happened. You want to paint the picture for that underwriter. Usually it's because of a drop in household income, because of a job loss or a job change, or an increase in household expenses because of an unexpected expense that came up. You had a family member with a stroke that's living with you now, or you had some other medical expenses to pay for, or something along those lines. And then you have to prove to the lender or explain to the lender and document it why it makes more sense and why they will recover more by doing the short sale versus letting the property go into foreclosure. You do that with comps that you can get and show that comps for short sales are higher than comps for foreclosures. You can also show to the lender that the length of time on the market is longer for foreclosures, so that's longer they're going to be waiting to get paid. There's more attorney costs when they have to go through the foreclosure process. And then there's always the issue of recourse versus non-recourse. If you're in a non-recourse state, they can't come after you for any of that deficient balance, so it obviously makes sense for them to recoup as much as possible, as soon as possible, and the short sale is going to be that option for them. This is a list of the typical waiting period requirements for Fannie Mae and for Freddie Mac, and then FHA, and for the other government loans. They're very, very similar. FHA is to VA and USDA, but if you want to know specifically what it is for other programs other than Fannie Mae or FHA, please give me a call. Now, there's another thing called the Mortgage Debt Forgiveness Act of 2007. Okay, that was passed back in 2007 when in advance of the financial crisis, but back when there was a lot of foreclosures already happening. What the government decided to do is, in the past, prior to this act, is that if you had a $50,000 difference, like in our example, you would have to pay taxes on that like ordinary income, and it was like kicking the homeowner while they were down. They already just went through a foreclosure. I had to go through a short sale. Now they got this deficient balance. If they're lucky enough to be in a non-recourse state where the lender can't come after them for the balance, they still might get stuck with a 1099 for the income. And so this act actually protects them from that, as long as, and it protects them up to $2 million, as long as it's a principal residence and it was acquisition indebtedness, meaning you used the money to acquire the property and it wasn't home equity indebtedness. You didn't get a home equity line of credit against the property. Now, the thing that's important to remember for this particular caveat when it comes to short sales and foreclosures is that the exclusion expires on January 1st, 2013. So this is probably your last year to take advantage of doing a foreclosure or a short sale and getting out from underneath that mortgage balance without being hit with a 1099 in order to pay taxes on that deficient balance. There's a couple of exceptions you have to fall under in order to be able to not have to pay for that tax liability on that discharge debt. Basically, your total debts have to exceed your total assets, excluding those things that are beyond the reach of creditors, like pension plans and retirement accounts, which for a lot of people, it's not that hard. If you got a $300,000 mortgage, if you don't already have $300,000 in assets that aren't part of a pension plan or retirement account or other things that are out of the reach of creditors, well then you probably qualify for the exception and you won't have to pay taxes on that discharged debt. If your property qualified for real property business indebtedness, owner-occupied commercial property, it gets a little bit more complicated. You want to talk with your business CPA about that for details. For obvious reasons, this benefits the homeowner because being able to get out from underneath the debt that they're having trouble affording reduces stress. Getting out from underneath the house opens options, means that they can move now and take other job opportunities in other cities or states. And obviously it will save them money. What should you do in that case? Hey, give me a call. I'll be happy to talk to you and see if a short sale is the best option for you if we can't find a way to keep you in the home through refinancing. Then there's also the option of rent-to-own sale leaseback. Now, there's some people that know who this guy is. If you don't, his name's Warren Buffett. He's probably the richest man in the world. Basically, whenever he talks, the market listens. And he was on CNBC not very long ago this spring, and he basically said, if I could invest and I could take my money and invest and buy 200,000 to 300,000 single-family homes with 30-year mortgages, I would. The only problem with that is managing those properties, and that's the reason why he wouldn't do it. But what he's basically saying is if you have the money to purchase 1 or 2 or 3 investment properties and rent them out, this is the time to do it, because getting a mortgage from the bank at 4 or 5 or even 6% is like shorting the dollar. Eventually, inflation will catch up with us. And when it does and rents go up, you're going to be in a position to actually do very well with those rental properties, collecting more rent as the market rent goes up and having your payment fixed based on a 4 or 5% mortgage. I connect investors with those tenants that want to be homeowners. So I have a separate presentation for this particular program. If you are an investor who has $40,000 to $60,000 that you want to invest in a 2 to 3 year period, give me a call. And if you are a potential homeowner who can't qualify for a mortgage because of one reason or another, and you are intent on reestablishing your credit in a 2 to 3 year period, give me a call. I'm a matchmaker. I like to match homeowners with investors and those homeowners who want to eventually buy that property from the investor. Basically, in a nutshell, it's a rent-to-own program for the investor to purchase a property that the tenant wants to live in and plans to buy. You do 2 separate agreements. You have a lease agreement that gives the tenant the right to rent from the landlord, and then we do a separate option agreement where the tenant has the option to buy the property from the landlord, but based upon a 5% of the purchase price deposit. Again, I can go into details on that. Sale leaseback is a little more tricky, and call me if you think that you might be able to take advantage of this. But basically, if somebody's already in the foreclosure process, they can't do this. You'll have to check with the foreclosure laws in your state, but in Arizona, I'm pretty sure that you can't do this if you're already going through the foreclosure process. So you can't use it to save yourself from a foreclosure, but there is the option for somebody to be able to lower their payment by doing a leaseback. So again, you should call me if you have any questions about basically hooking up with an investor, or if you are an investor looking for a good place to invest your money and see returns of anywhere from, let's say, 10 to 30%, depending on the individual property, then give me a call. My contact information is right here. I invite you to give me a call anytime. That's my cell phone number listed there at 602-705-6293. Or drop me a line via email. And I invite you to check out my blog at spenceranglin.com and subscribe. Thanks for listening and have a great day.